Welcome to another episode of Equity Mates. Super pumped for this episode. My name is Bryce, and as always, I'm joined by my equity mate, Alec. How are you?
I'm good, Bryce. Look, there's no hotter sector at the moment, well, in Australia at least, than the buy now, pay later sector.
Yep.
We've seen Zip up, over 100% year to date. Afterpay, all of the buy now, pay later players are continuing what they did in 2020. And so we figured we couldn't go another week without talking about them.
Yes.
So we're here to talk about Afterpay.
We are here to talk about Afterpay, but it's not just Alec and I chatting. We are going to be bringing back the bull versus bear segment, and we have brought in two of our favourite experts, each to present a case. So it is our pleasure to welcome in the studio Michael Frazis from Frazis Capital Partners. Michael, welcome.
Thanks for having me on. Appreciate it.
No worries, and you will be presenting the bull case for Afterpay.
Well, indeed.
Looking forward to that. And we have joining us on Skype, Andrew Page from strawman.com. Andrew, welcome. So, Andrew will be presenting the bear case, but I'm sure you can't hate Afterpay. So I'm looking forward to hearing what he thinks about Afterpay. But so how this is going to work is, as we said, Michael will present sort of 2 or 3 minute elevator pitch on why Afterpay is going to continue the way it is, and then we'll throw to Andrew, and then we'll have question time.
We'll just let the two go at each other. Have a lively debate.
Luckily, they're both not in the studio because things could get crazy now.
So, Michael, why don't we start with you? We're pretty optimistic people here at Equity Mates, so we want to hear the bull case first.
Sure.
Give us the bull case for Afterpay.
Yeah, I guess with Afterpay, if you take a step back and think like, what is a good credit business? It's something that's like really short-term loans and really small value, and preferably something that doesn't compound into something that people can't pay. Afterpay, you pay 25% at once, and then you get the rest 2 weeks later, 2 weeks later, and 2 weeks after that. So it's super short. It's also really small. Now, think about the returns they make. I'm just taking it from the beginning, right?
Yeah, of course.
The returns they make, they take 4% gross, roughly, sometimes more, sometimes less. But that's over kind of 6 weeks. Like, that's a really short period. So it's actually a higher interest rate than a credit card over a much shorter period than a credit card in terms of like the credit risk, with much smaller amounts. So that's kind of like the broad fundamentals of the business. Why it's such a good investment case is basically, we bought it $4. Since then, it's maintained over 100% growth, for 5 years in a row, basically. So it doubled, and doubled again. And that's that increase in growth where you go from a few 100,000 customers, 500,000, 1 million, 2 million, 5 million, 10 million. That's where you get companies that grow materially in size and create a ton of value. We're always trying to be on the right side of those huge increases in value. So kind of where are we now, that this many years later and this kind of far into the story? Well, we know that it's still maintaining 100% growth. We know if they do that 2 years in a row, that's 4 times. Maybe it'll take them 3, maybe it'll take it 4 years. 4 times is pretty impressive, numbers. But, it has run hard. What I'm saying is very well recognized by the market. We could talk more about one of the interesting things about Afterpay is people talk about it, losing money. But this is one of those stocks where they're losing money in the best possible way. They're hiring staff, they're spending money, they're opening offices in new territories. Think of the costs it took them to open up the United States. All the money they were making as Australia matured, they then invested in hiring staff. So some of the top tech people in the world in the United States having a proper red hot crack there. The UK, shortly after, and then Europe and potentially Asia in the future. So they're kind of like multiple avenues of growth.
So we've just heard the bull case there from Michael. Andrew, I'm interested in your rebuttal, I guess. Can you give us the bear case for Afterpay?
Yes, I can. But I'm going to start off by suggesting that it's actually a phenomenal company. And I know that's probably not what I should be doing for the bear case here. Look, this is a business that didn't have customers back in 2015. Now it's got over 12 million of them. And Michael has just pointed out some of the incredible growth that they've had. It's a $43 billion company today. The market cap's up 25-fold in the last few years. Incredible user growth, incredible revenue growth. I think it's a business that's much bigger and profitable in the future. So there's nothing bad, I have to say, about the business per se. My argument really comes down to one of valuation, because no matter how great the business is, you can still do badly in a great business if you pay too much. So I fully tip my hat to Michael for buying this at $4, but that was a very different proposition than what it is now. So I'll put some numbers around this if I can. So last year they made about $500 million in net revenue. So shares are 83 times that level. Now, let's say they do double that again this year. That's probably what they are going to do. You're still looking at a price to sales ratio there of about 45 or so. Now, to put that into context, Tesla is on a price to sales, P2S, of 26 times. Even when you look at a lot of strong, phenomenally fast-growing tech companies out there, it's usually 10, maybe 20 times. And this is, as I said, this is a big company, 43 odd billion dollars in market cap, trading at that kind of multiple. So it's the situation where you not only have to have very, very fast growth, but you need to see very high multiples maintained as well. If either of those two things fall short of some very lofty expectations, you're probably not going to do great as an investor. So let's have a bit of fun with some numbers and play around here. So let's say I went and actually started off with 2023 consensus guidance from analysts here. So a few years out, as they've passed through that break-even inflection point, profitable, fast-growing company, they're saying about $1.10, $1.11 in earnings per share at that rate. Let's grow it for 25% per year for another decade after that point. So 2033 now, after profits have soared to more than $3 billion. For you to make a 10% return, you need shares still at that stage to be trading at a PE multiple of 50. So you can pull those two levers any way you look at it, but both of those forecasts have to be very, very robust. So it's more about looking at this from a risk-adjusted basis, because if anything doesn't go perfectly to plan, there's a lot of downside.
So a lot of agreement there, I think, in terms of the business of Afterpay and the growth of Afterpay. I was actually a little bit worried there, Andrew, that you were going to give the bull case as well. Michael, I'd be interested to get your thoughts on the valuation point. How do you think about Afterpay's valuation at the moment and going forward?
Yeah, look, there's no doubt that it's kind of, I guess, run ahead of itself, is how some people think. I think it's interesting, Andrew, you mentioned it was kind of such an amazing company. It's amazing how often kind of people bring negative arguments towards companies like that. And in the last few years anyway, those have all resolved decisively to the upside. To think about valuation, look, if you talk about, I don't have the 2023 numbers ahead of me, but I do know estimates are rapidly, bringing growth down. The reason they do that is if you make forecasts, if you say something's going to maintain 100% growth for 5 years, you end up somewhere silly. You end up with one of the best performing stocks in the market. And that's exactly what happened 5 years ago. So we've been constantly, every update, we just write up our model, from where the analyst estimates are. So there's a very good chance, they dramatically exceed by 2023. The other thing that's worth noting is that it's a time frame thing. If Afterpay is great and people like it, and we know that, and they've basically got 3 compound layers of growth. So they're adding customers are spending more and more, and they're opening up entire new geographies. We'd probably all agree on those 3 things. There's a good chance, where will they be in 2023? They'll probably have amazing growth and prospects ahead of themselves, new products they can do. They'll then be valued not on 2023 numbers, on 2025, 2026, 2027. And that's kind of how these fast-growing companies can do so well while they always look expensive. It comes down to time frame and how long they can maintain that high growth. And so if we can agree that it's a great company, we can agree there's actually a very good chance that it does that. But of course, Andrew, it does come down to risk reward. Is the juice worth the squeeze? Could it drop 30, 40%, to run very hard into earnings? Of course it could. But it could also compound at 100%, if not every year, every 18 months or 24 months, for the foreseeable future. And so for us, the juice is worth the squeeze. The reward is worth the risk. But, that's, people can have opposite opinions for sure.
So, Andrew, on that point, we've seen in this sort of latest tech boom that a lot of these tech companies are able to, run ahead of analyst estimates in terms of growth rates. We see Microsoft, Amazon, Apple still achieving incredible growth rates, still smashing estimates, and they're, decades old companies. How do you think about that? Do you think Afterpay could be one of those companies that, is achieving 100% growth rates for years into the future?
Yeah, and it's really important to clarify this point. My argument isn't that they won't do this. They've got a reasonable chance to do this. I mean, let's look at Visa. Visa makes processes something like $8 trillion worth of transactions every year. There's a huge market here, and they could end up being a great player. And if they are, you will get a nice return from here. But on a risk-adjusted basis, what I'm saying is if anything short of that happens, you won't get those returns and you could well have losses. So I think one of the things to remember here is that although they invented this category, although they're the dominant player in this category, although there are genuine moats, I think, in the terms of the network effects that the business has, I don't think that there's incredibly high switching costs. It's very easy for me to download another app and process through a different provider. We've seen just how many new entrants have come into this space. PayPal and Visa have come into this space as well. So what you're doing is you're not only assuming this big runway for growth, which I think is legitimate, but they'll be able to capture that with all of these other very well-funded entrenched players just saying, yes, you can have that, and not putting up a fight in any way, shape or form. And even if they do win significant market share, will the margins be the same going forward? And again, I'm not here to make the case that, oh, this is definitely not going to happen. It could happen, but it also might not happen. And you're making the gamble here that if this is guaranteed to happen, I would say Afterpay shares are still cheap, but it's far from a guarantee to my mind. And you're just getting margin of safety is those three words that all investors should memorize and should be their mantra. And my argument really rests on the crux of there is no margin for safety. This is everything goes incredibly well and you do well, or anything short of that, and you're probably not going to get the best returns.
So, Michael, we saw, Andrew here talking about the multiples that Afterpay is trading on, but if you look at where it sits against its competitors, Zip is trading on, significantly less multiples at the moment. And the question always arises amongst our group of friends, why is Afterpay booming and Zip, up 100% year to date, but the price growth that we've seen is nothing compared to Afterpay. What is it about Afterpay, do you think, that separates it from Zip and its other competitors?
I think there's two comments on that. So what separates Afterpay? Afterpay was always, they were the market leader. They did it best. If you put like Afterpay and Zip or PayPal, Afterpay was always consistently winning market share at the point of decision. Afterpay was incredibly disciplined. Like they've had one product that they've taken the whole way. They've won. Imagine how easy it would have been to offer a new credit line or something.
Yeah.
And that's kind of what Zip always was. They always had these other business lines. They give you a line of credit. But having said that, what's interesting about Zip is actually QuadPay. QuadPay is going gangbusters. I reckon that was a very good purchase from them. And by all accounts, the integration is working well. The teams are working well together. And so I think if one of the reasons like there's kind of been a recent uplift in Zip is because those numbers from QuadPay have come out as well.
Yeah.
So where they sit on the value perspective, we own Afterpay, we don't own Zip. We'll always try to stick to number ones.
Yeah.
You kind of get more lucky when you're with the number one, I've found. It's an interesting thing.
Yeah.
Point of coin.
Andrew, what about you? How do you think about the competitive landscape? We've got a lot of Australian companies. We've got Hum changing its name to capitalise on the buy now, pay later trend. And then we've got some overseas entrants. Given that you're the bear, would be interested to hear your perspective on the competitive landscape and how you think it's going to play out.
Well, I just repeat my point from before. The very fact that we have so many new entrants demonstrates that there are very little barriers to entry to get into this space. Now, winning in this space is an entirely different thing, but it's not hard to set up shop here if you want to. And there's going to be someone out here, and perhaps it's an established player, perhaps it's someone entirely new, that is just happy to offer the merchants a far better rate, is happy to offer consumers a far better terms and conditions, and just reduce the margin. It's the whole Jeff Bezos, your margin is my opportunity kind of thing. So as soon as you unleash those competitive dynamics in there, it just makes the market share argument and the maintaining margin argument more difficult. Again, not impossible. Afterpay has the best product in its space. It has the most traction. It has the most momentum. But to think that it's going to be able to sustain all of that growth without the incumbents making any kind of move, and maybe they're completely inept, maybe they mount a very terrible response. But the fact that they can launch a very compelling competing product, and the fact that it's very easy for me to download a new app and switch to a different provider if I so choose to, that to me just, again, elevates the risk a little bit.
To follow up on that, Andrew, and I'd be interested to get your thoughts, Michael, as well. Isn't there two switching costs we're talking about here? The first one is for the customer to switch to a different app. Isn't the second one for the retailers who are partnering with different buy now, pay later companies? And if Afterpay has captured all those retailers, there may be a switching cost there to switch to a firm or a PayPal or anyone else?
I don't think it's an either or. I think you can have both, and you see a lot of retailers that do have both, right? So it's not hard to integrate a new BNPL provider into your systems, and merchants will do that wherever they think it adds value, and they'll be really more inclined to do it if it's someone who's able to offer that service to you with a lower cost to you as well. So again, as I said at the start, I think Afterpay has legitimate moats. It's a great company. It really is. But to think that this is just wide open for them and them alone, and I know Michael's not saying that, but that is where I urge some caution. And then to, again, apply that margin of safety, account for those risks, look at the asymmetry in your return profile, which is everything shooting the lights out, maybe 10 or 15% compound return over the long term, or falling well short of that and losing 50, 60, 70% of your money. It's just, to me, it would be a very different proposition if the share price was half what it was, but we're here at what, $150, maybe it goes to 250, but on average over the next 3 to 5 years, I think it's going to be hard to score a pretty decent capital return relative to the risks.
Well, we like bold predictions here, so we'll close with a one-word answer. Will Afterpay be up at the end of the year from where it started to 2021?
Where it started 2021 or
Yeah.
it is today?
Okay, let's go from today.
It's going to be much harder.
Yeah.
We'll see him as the bull. I'm going to say up.
and Andrew?
Oh man, well, I guess on that basis I have to say down. But again, I want to make it clear: we're seeing some really interesting times in the market. So this could get to $500. I would have seen crazier things, but obviously it's an inverse relationship to returns. The higher that goes, the more difficult your returns become.
Well, unfortunately, that is all we have time for. But Michael, thank you for joining us. It's been an absolute pleasure chatting as always. And Andrew, thank you very much as well. If you'd like more information on either of these two gents, where can they find it?
Probably frazerscapitalpartners.com.
Beautiful. And Andrew?
Head to strawman.com and you can tell me why I'm wrong.
Well, it's been an enjoyable conversation. Hopefully you managed to get something out of that will help you on your investing journey. Afterpay results out on Thursday, so looking forward to seeing how they perform. But as always, it's been a pleasure to chat to some experts. So, yeah.
Yeah, and join us tomorrow, same time, same place. We're bringing back Watchlist Wednesday, so tune in for that. Until then, thanks for watching.